Certainly, when we look at the economic data that we've been seeing, whether it's today or last week, the data has been inconsistent and it's been inconclusive. You look at ISM, not so good. You look at auto sales, very good. So this perverse idea that traders have been living on, it's been income at any price in this market. And the idea that we get disappointing news and all of our problems are solved, I think is incredibly short-sighted. We need to see higher rates here. We need to see the market show strength. We need to show economic growth. That's been the missing component here. We still don't see that in economic data. That's why the Fed's still in the game. Now, my personal opinion is higher rates would be a good thing for the market, but the Fed can't take its foot off the gas. They should, but they won't. So don't fret the taper and don't fret the Fed, and I think traders would be better served. Every trader is watching the exact same trade, and that's what gets us in trouble. I mean, that correlation becomes manufactured. As we all stare at it, we start to believe that is truly what's moving the market. At the end of the day, it's the fundamentals in Japan that are going to move the market. You got to get the Nikkei noise of the yen off the table so you can focus on the fundamentals of those exporters, and that's what's missing here. Regardless of what happens with Friday's jobs data, the dividend ship has sailed, and the market is rotating. And if we look at what is leading the economy and presumably going to lead the market going forward, it's going to be domestic energy production, which is just ripping, and housing in certain areas of the country have recovered, and it is in a full recovery, and we're actually seeing speculative excess. That's how much housing has recovered. So you'll see home building, construction, all those things that go with it. So a rotation to cyclicals and industrials, and that is what's happening underneath the market, and I think that trend continues. So the market might move higher, but it depends on which piece of the market you're talking about. Those dividend strategies, balanced funds had record inflows for the first 4 months of the year. That's not going to repeat itself going forward. That's where the change is going to happen. Anyone who's got cash is looking for a pullback, right? They just won't admit it. It's tough because people are looking for that 10% correction. You certainly don't get it. Is the market overbought? Yeah, it could stay overbought for a long time. You got to put the money to work. It's not about being right. It's about trying to do the right thing going forward. And it's really tough when the market's up this hard. But look, it's a tough game. You know, everybody's biting their nails and holding their breath and sleepless nights ahead of Friday's jobs report. You got to get over it. You got to move forward. We need some economic growth. If we get that, you'll see the market rotation. It's going to solve a lot of problems in the economy. Dividends were so 2012, right? Just like Apple and gold had their day, the dividend story had its day. But just to touch upon the Japan story for 1 minute, you know, there's a whole side of the Japanese market that focuses on the domestic Japanese market, some of the smaller companies, not the obvious export plays. I mean, sure, Toyota's going to sell a lot of cars when car sales are good, but don't buy Japan just because of Abenomics, but buy it because you think there's a policy shift and you think the fundamentals of those companies has turned, which I think it has. If investors are underweight U.S. equities, they're really underweight Japan because they've been selling those stocks for 20 years. So that's where you're going to see the recovery. Maybe we've already seen ours.